Hello, and welcome to this new YouTube channel, The Red Candlestick. Um, if you can, subscribe, um, especially if you're interested in this type of stuff. Today we're going to be talking about, government bonds. And the reason why we're going to be talking about government bonds is because I personally believe that government bonds are in a bubble, and I will show you some reasons why they could be in a bubble. I will like to say that I do have some libertarian values, so I do I have more of an economically right-leaning point of view, but let's start by looking at some of the bond ETFs out there. So I broke it down into iShares uh, 1 to 3 years, 3 to 7, 7 to 10, 10 to 20, and 20 plus. So one thing that interests me about this is that as you extend in length, the amount coming from appreciation rather than interest payments is much higher. Now, the only two examples where it's the reverse, and it's not very much of a reverse, is yeah, it's not really much at all. So, actually, was it even a reverse? No, it wasn't. But yeah, you can see that just slowly, as you increase the length of it, it goes up in appreciation compared to dividends. Now, the why this interests me is so, okay, let's go to the different bonds. So, 1 year bonds, complete collapse. And part of the reason why it's a complete collapse is because the Fed basically set interest rates to zero. This is the World Government Bond website. So, they got a lot of information like this. A lot of especially if you're interested in this type of stuff, that back in 2018, there was a taper, and they stopped the taper, especially with COVID-19, where it was a complete reversal from that, because they noticed that the market didn't really like that. So, it's the same thing with the 2 and the 3 year. Less drastic as you go up. And 5 year, it just keeps, the amount that it goes down, it seems, is far less drastic as you go up. And part of the reason why is because the shorter term bonds are more controlled by the government than longer term bonds, especially the 30-year bond, which is known to be not really controlled by it. So there's more, you can't really say these bonds are very free market, because there's no way the free market would agree to a 1.8% interest rate for 30 years. I mean, that is ridiculous, especially with the currency risk. And even historically, inflation has been 4% over the past 100 years, so why should I expect different? So, yeah, a little bit. But, obviously, as we go back here, especially the TLT, this has gone up like 6.5% over the time period that I put these all towards, which is 14 year. Wait. What is it? I'm pretty sure about 14 years. Yeah, it was. Yeah, it was 14 years. Yeah, I had to put all of these at about the same time because there were some issues with it. So yeah, it was about 14 years. So 2007 or something like that to today. Yeah, 2007. Because I remember doing 2006 and some of them were not at the same time. So, you run into some issues, especially because ETFs haven't really been around for that long. But it still gives us, some data, obviously. I mean, it's quite interesting to see that the longer the bond is, the more it's tricky to appreciation, which means that there are people purchasing the bonds, and by people I mean pension funds mainly. And obviously, as I showed you here, even though 30-year does not seem like it's as much in a bubble as other bonds, especially the 1 year, it's probably much more so in a bubble than 1 to 3 years. And the other thing about 1 to 3 year bonds is that those are part of like the banking system. So I also think another thing is quite interesting with interest. So if I go to the 1 year chart, there has been some pushing up of interest rates, and that's partly to do with supply chain is one thing, and governments giving out stimulus is the other, as many people know. So this is the Chinese yuan versus the US dollar. So what I want to show you here is that it's about June when the Chinese yuan started to go up, and if we go, so June, as you can see, that's when interest rates are starting to pick up again. So interest rates started to pick up around here. Now this year, yeah, that was last June. Now this year the dollar has been going up, and that's because people are expecting a taper, but which, I guess you could say that attributes into the bubble idea, but I would not say that's the main reason why a bubble will happen. Now, I will like to say that the China and the US are major economies. So, the GDP of China, 14 trillion, GDP of the US, 21 trillion. Two major economies. And the US does a lot of trade with China. So, if the Chinese yuan goes up against the dollar, that means that for the US, that would mean that it becomes more expensive to buy goods because a lot of our goods come from China. And China, I mean, by their own buying power, they are a bigger economy than the US. So they have a lot of influence in buying power, especially since they can produce stuff much cheaper than the US because of that. Now, over here, we can see that China's debt to GDP ratio is 55%, the United States is 106%, much higher. Also, I could show that so China, let's see. So it's not really too much higher. Like, you would expect that bond yields in China would be much higher than the US because of perceived risk. That's not really too much higher, and their yields have been going down. I would attribute a lot of their yields going down most likely to the Evergrande crisis and real estate crisis and whatever is going on in China. There is a debt crisis in China, but that debt crisis is more to do with the private sector rather than the public sector. It's 3.5% compared to the U.S.'s 1.8%. It's really not that much higher. And they have half as much debt, so, to their GDP. I guess I could show one of the situations. Turkey. Turkey is a situation where they have been destroyed and from high inflation, and as I showed you here, the Chinese yuan is going up against the US dollar, and in Turkey they have dealt very harshly from Erdogan's policies, and the reason why it has been so bad in Turkey is because of Erdogan believes that lowering interest rates makes the currency stronger. Well, I disagree with that notion, because as someone who believes in a more Austrian type of economics, I believe that lowering interest rates means that you make debt less expensive. And making debt less expensive means that it's easier to get money, which means that your currency will go down. If you make debt more expensive, then your currency becomes more expensive. It is just basic economics. Obviously, Erdogan does not believe in the basic economics. So, something to look out at. Actually, I could pull up Turkey's, where is it? Turkey. Down here. So, Turkey has been quite interesting in their yields, because their yields have skyrocketed. Yeah, see, it has literally just skyrocketed. And Erdogan has been, like, throwing out one after another of his, chairmans at his central bank. I mean, geez. One of his chairmans reduced interest rates down to 8.5% and raised the interest rates, as you can see here, and then he was fired, and then interest rate. It's a mess, I really do not understand what in the world makes everyone think that continuing his policy makes it, it really does not make any sense. But, it's not me to judge. It's the world to just see. And, yeah. Also, CPI index. September. Is it September, or should I be putting October? I don't know. Honestly, I forget what. Oh yeah, it's October is the month I should be putting in. October 2021. Okay, here it is. So, yeah, inflation hit like a high of like 6 point whatever percent. And obviously, even if we look at our 30-year bonds, they're paying nothing. So, wait, that's not 30-year, but even if we look at our 30-year bonds, they're paying nothing. 1.8%, 6% inflation. I mean, that's just will destroy you. I mean, I don't know who in the world would just dump enough. I mean, in the end, even something as safe as a bond, their value is really attributed to, the fundamentals of the country, the fundamentals. I mean, you know, just lowering interest rates or the government buying the bonds, increasing the bond prices, does not mean that, that continues forever. Just because something is safe doesn't mean it's safe forever. I mean, also, it goes the other way around. Just because something is perceived as risky doesn't mean it's actually risky. Because in certain situations, risk is just the chance of permanently losing money. And, you know, that's all it really is. And every asset is the present value of all future cash flows. So, I mean, according to the past, this is really bad. I mean, really bad interest rate. I mean, that's all I have to really say about it. But it's something to look into. I would recommend that people do their own research. Obviously, this might help you. Good start understanding the appreciation versus the interest payments. It should be a good start. But there's a lot more things you might want to understand. Especially what I showed you with China USD. There's other economies out there. I mean, in general, we saw a huge push in currencies against the US dollar, most likely because of what has been going on in the US, and it makes sense. But it is quite drastic. And whoa. 13? Wait, what was it down here? 14? It went up. Wow. That's insane for a currency. It just seems a little bit crazy. So, yeah. I would be looking out for all this stuff. And yeah, that's about it.